it's as you can see from my eyes, sleepless nights and the usual that you get from a newborn.
It comes as a cost, unfortunately, but no, it should be brilliant. Right. To get things going once again, we've had a bit of a break, but now we're going to jump straight in with a new analysis of a company called Domino's, which I'm sure everyone watching has probably heard of if they've ever ordered a pizza online. So why don't we start with a quick refresher? What is Domino's?
So Domino's, being the Domino's Pizza Group, as most people will be aware of, is a US fast food pizza chain. Now, the company that we're looking at today and what we analyze in our notes, which you can look at in the description below, which is a full set of notes which we write on each company that we talk about in these videos, is essentially it's the franchisee of the US brand. So it holds the master purchasing agreement to basically license and use the brand of Domino's Pizza in the UK, Ireland, and various parts of Europe. And they operate out of the UK, and they have so they're listed on the London Stock Exchange, and you have Domino's Pizza, which a lot of our US viewers will know will also have another listing in the US. They're two different listings, and people need to understand it's not the same company listed twice. They're actually two different entities. One just being the master purchasing agreement, which we're going to look at today and discuss. Now, a bit more about Domino's in terms of the UK. So the way it works in the UK is that they pay a 2.2% royalty fee to the US, to the brand, to use the license and use the brand, and making sure that all the ingredients, etc., are in line with Domino's. And the way they work is they have about 1,000 stores in the UK, and of those, 35 are company owned, meaning Domino's, the group in the UK, own those and they run them, and the rest are all owned by franchisees. So these franchisees basically pay a royalty to Domino's UK, 5.5% of sales, and also they also pay they pay rent and they pay for ingredients, etc. We can go into a bit more detail. But to open so those who might be interested, to open a franchise for Domino's in the UK, you need £120,000 of liquid assets, and then you need to borrow 160,000. But looking at some of the research I did, I think in 1 or 2 years you can turn over 200. Well, your profit could be 250 to 240,000. So not bad.
As setting up a franchise business, that's relatively cheap, all things considered. I can't remember off the top of my head, but I think for McDonald's, the initial startup cost was closer to $1 million or something.
I've seen that, and I've noticed that. I think that's changed as well. I looked at it recently. Okay. Maybe their requirements have gone down in terms of liquid assets because they're trying to encourage more people to do it. And maybe there's sort of others in terms of experience and managing it for a while. So there are different sort of models, but yeah, I think it's quite hard. I think to find a location is one thing quite hard, given how well known they are now, these brands in the UK, and finding new ones. 1,000 stores is quite a lot. So finding new locations is difficult, and then running them and making them successful again is somewhat different, of a difficult task for those who are running it, because they've got to get training themselves and then hire the right people. And we could talk a bit about that in detail, but yeah, it's very much from Domino's UK perspective. It's actually not where they make most of their money, which is surprising. It doesn't really matter. I mean, that 5% that they're earning on those royalties isn't really a major part of their revenue. There's actually something more interesting, which is a major part of their revenue. So it's.
Do you want to go into a bit more detail then? What is the primary driver of the revenue stream?
So why don't I just share the notes that we actually do on the Money Cog. So if we look here, we can see here revenue and cost drivers, how the money is flowing in and out. So just quick on our notes, we talk about how the company makes money, what does it do, stock performance, revenue and cost drivers, fundamentals, and management, etc. Now you can get all this information if you go on www.themoneycog.com and you sign up for a free account. You'll be able to get access to this information. And the information is in the link in the description below. So going back to specifically Domino's. So Domino's last year made £560 million revenue, of which majority of that actually comes from ingredient supply chain. That's 374. And what that is essentially all the ingredients that you have on pizza. So whether that's the pepperoni, the chicken, the beef, all those ingredients, all the toppings and everything, the franchisees actually have to buy from Domino's UK. So you can imagine that's where they buy the supply from. Now, obviously, there's massive margins in that, and that's where they're making their money. So you can see the royalties and actually the rent. So we put here rental because what happens is actually the properties, even though they're run, Domino's doesn't own those businesses, they actually own the freehold. So they'll take, they don't own it in terms of freehold, sorry, they lease it. So they lease it and then they sublease it to the franchisee. So just to clarify, it's not a freehold, they own the lease. And then they sublet that to the franchisee. So that's where this revenue comes from, which is about 80 million. And then company-owned stores, obviously, is the margin of them themselves, getting the margin for selling it to the customer. And then they make some money on e-commerce, and basically they charge a fee for the platform for all those franchisees to do it. So that's how they make the money. But healthy profit, most of it comes from the ingredients, which sort of can make sense when you think about it, because it's where any I looked into a bit more. Any quick service restaurant business makes most of their money because the franchise, the 5% of revenue is very tiny for them. It's mainly selling them the whole ingredients, and it's part of the brand as well. Keeping it consistent across all stores.
I suppose by forcing franchisees to buy ingredients directly from Domino's headquarters, if you like, it also allows the management team to gain a bit more control in terms of quality of those ingredients. It doesn't allow franchisees to try getting cheaper ingredients from elsewhere to potentially then compromise the quality of the product.
Exactly, yes. The quality is there, and also they have pricing power in that they can buy these bulk and see what they can do. And I know, having read online in Domino's in the US, they try to get cheaper substitutes, and that didn't go well over the years because the taste goes. So you always want to keep that quality by not losing. You want to get lower prices for your ingredients, but you don't want to lose the quality. So it's got to be a fine balance. Exactly.
So I imagine then, because ingredients are obviously such an important part of making pizza, you can't do it without it. That component of the cost of sales so much is going to be where most of the money is going in terms of cash flow, the expenses.
Exactly. So more than 50%, well, close to 50%, 52% is cost of sales. So it's just the raw ingredients. So quite a large amount. And then after that, it's the administrative costs. And you can imagine that's just the central bodies. And given it's a franchisee model, it's quite light beyond that. So they don't have huge amounts of other costs. Distribution is 6%, and then you've got finance, which is very small at sort of 3%. So top heavy, it's purely ingredients. So it's a fairly light cost structure, and that it's one or two items which make the bulk of it. So from our perspective as investors, very easy to understand. And this is why I like this business, because it's very easy to understand the drivers. And we always talk about in the Money Cog is people fail to understand the business model of a company or really understand how it makes money. Because ultimately, what you have to understand is whatever's being priced into the stock price is the expectations of the market. Now, you as an investor, or me and you, are saying that expectation is wrong. And why is that wrong? So you've got to say, well, actually, there's more growth than what the market's pricing in. And you can sort of imply what those growth rates are through looking at what the market's DCF and et cetera, and then saying, well, actually, there's more upside. But yeah, it's a very fascinating topic where once you understand the business model very well, you can then start to think about the different aspects, which we look at in our notes, which they can look in the description below, that gets you to where valuation should be, which we'll talk about a bit later. But yeah, cost, knowing the cost drivers, you can say, well, are there any tailwinds? That are going to massively increase costs. So in this case, you could say maybe there are some in terms of inflation. So the cost of food is going up massively. So that might be something that would hit Domino's, and how much can they pass on to the consumer? But we can go into that a bit more detail about threats and issues of the company a bit later on in our discussion. But yeah, that's just an outlier there that you got to think about. But you wouldn't know that if you don't fully understand the business and the drivers, and how big of an impact could that be? Is again really understanding the revenue drivers and cost drivers.
Especially for a business that operates in a highly competitive environment. I mean, there's so many fast food. In pretty much every town, you'll find either an equivalent like Papa John's or just a local pizzeria serving basically the same product, even if there is differences in quality and flavor. And yes, you have some brand loyalty. But if a Domino's pizza suddenly needs to increase by 30% in terms of price because the price of food is going up and they're trying to pass it on, eventually people aren't going to be willing to pay that premium, especially if consumer spending is getting tight. Exactly.
So it's one of those things where you might see a massive drop because it's very cyclical. Because you go into a recession, how many people are going to be ordering takeouts? People might just be wanting to sort of eat at home and cook their own food. So, or get a pizza from Tesco or
Yeah,
Beans a week.
I'm guilty of that actually. I tend to buy the plain margaritas and then spice them up with all sorts of
Excellent.
ingredients.
Oh wow, that's very good.
Okay, getting back on topic, from a fundamental sort of balance sheet perspective, well, looking at the notes, things seem to be relatively healthy. They've got a nice amount of liquidity, but there is, which you sort of touched on already, there's a large sort of lease liability that appears on the balance sheet. Would you like to go into a bit more detail?
Yeah, so there is something called sort of so we mentioned earlier on about the leases. So the company will basically take leases on the properties and sublet it onto the franchisees. And what that means is that we tend to add lease obligations into debt. So you end up getting quite a large debt amount, which you get up to about 203 million if you include the leases. But actually, if you look at the net debt, so you take into account cash, because this business is fairly cash flow generative, you get to a net debt to EBITDA, which is a good measure for leverage of about 2.9x. So that isn't too bad. It's quite low. And actually, when you look at, because those rents are being paid directly from the franchisees, there's limited risk on those lease obligations, because it's fairly easy to sort of see those lease obligations being met, and they're not going to go under, if that makes sense, because they've got fairly good insight into how well these franchisees are doing, and they tend to be, because it's got such a strong brand and franchise. Once you open one, they tend to be sort of quite profitable, and again, they're small retail unit spaces, so not as an individual unit, not a huge obligation, so fairly easy to manage. Yeah.
And the franchisees, in turn, they tend to perform relatively well in terms of finding customers, especially when they first open, because the online website where you actually order the pizza shop, that's run by headquarters, who then sort of dispatch those orders to the local branches. This is why it asks you for your location. It wants to find the closest branch, and then that order sort of gets passed on, which is helpful, obviously.
No, Domino's has actually a great sort of digital offering right now. I think one of the best out of all the fast food takeaway companies as a direct to consumer play, versus using the delivery apps as Deliveroo and Uber Eats. Domino's has got a fairly strong direct to consumer proposition, and one I think that they're quite happy and proud to have and going forward. And they collect a massive amount of data on that, because you can give great deals on emails and get people drawn into that. Free pizzas on Tuesdays if you buy this and that. All these different promotions they can do, and it makes sense for why they want to collect that data from their customers.
Okay, so we've looked a bit at the financials and the fundamentals. Let's talk about management. In 2020, we had a new chap come along, Dominic Paul. He had a pretty tough job, given that he basically came in at the height of the pandemic, where takeaways were doing relatively well, but because of general lockdowns and whatnot, fast food eventually started to struggle. So how do you think he's done since taking over?
Just putting perspective where he came from, because that gives you a good indication of his potential or what we should expect from him. He was sort of the CEO of Costa, so he was he was head of Costa Coffee. So that was sold to obviously Coca-Cola for 3.9 billion. Again, similar to what Domino's is trying to go through now. He sort of led the digital transformation of that business onto sort of apps and online, and he's done that very successfully, Domino's. So, in the case of Domino's, he's been able to turn that business around quite a lot, where over 90% of its sales come from its app, which is ridiculous. Think about that. It makes sense, because it doesn't make sense, sorry, but it's quite a tremendous figure, and that means he's collecting a lot of data on that, and that has a lot of value from an investor's point of view, because he's collecting all that information that he can potentially upsell customers, getting all that data, and do lots of interesting things with that. But one of the issues I have is that he earns quite a lot, much more than some of the CEOs we've seen on sort of the FTSE 100, FTSE 250 companies in the UK. He earns £765,000 a year.
Wow.
Which is quite a pushy number
for a pizza group. That is quite an impressive salary.
And one which is it's just a master purchasing agreement, right? It's not even its own brand.
Yeah.
So very, very very, very expensive as a CEO. But he has some incentives which are linked to shares, EPS, and stock performance, but it's very short term, in 2 years. So you sort of wonder, is he a bit of a one-shot pony? And the same way he sort of sold Costa, is he more of an individual that grows tremendous value very in the short term, but maybe erodes long-term value for shareholders in some of the decisions making he does. So it's too early to tell, but plus points for the digital transformation. Let's see what he sort of delivers in the long term. And in a competitive market, we've seen some new entrants into the market, but we're yet to see how Domino's does in the UK, and in what will be a very difficult year for cyclical businesses, I would assume. If we think of recessions on the horizon, and
especially ones which are dependent on commodities such as food in this instance.
Exactly.
All right, we'll have to see how he does, but he seems to be off to a decent start. You sort of touched on it a bit already with the whole collecting data and digitalization. Do you think that's what allows Domino's to stand out from all the competitors out there? Because it controls a fair amount of market share.
Yeah, so it controls, if you look at the whole pizza delivery market, 44% in the UK. Wow. And as a takeaway market sector, it controls about 6.8%. That's quite a large amount of numbers. But on the plus side, it has great market power, because people know, because of a strong brand, it can demand higher prices and premiums for their pizzas, just in the fact that it's well known, and it has a trust with individuals. And like you say, they've got so many locations that straight away when someone wants to order a delivery of pizza, it's either Domino's, Pizza Hut, what's the other one called?
Papa John's is another popular one.
But they're very expensive. But it's the quality of Domino's is always there in terms of price and quality. Domino's has always been number one, and they get great offers and great incentives for people to buy their pizzas. And they've been able to keep that consistency across all their stores. That you find it's something that's probably something that's under analyzed is how hard it is for these companies to make sure all the franchisees have the same quality. They have to have good quality controls in place to make sure each unit, each location is performing to standard, and they have internal measures for that. But again, one of the strengths is that brand of which they've got from the US is such a strong brand that it's very difficult for anyone. It's very difficult for anyone to replicate it in a sense. But actually, the barriers to entry are very low for pizzas. Me and you can open a pizza delivery shop all the time, and you see them in local locations. There's many different pizza places that have their own pizzas, and they do well as well. But they can't, at a high scale, they can't compete with Domino's. They probably compete locally. There's one or two groups like Flyaway Pizza, which is this new brand that's come out that's doing wood oven pizzas, and they seem to be gaining popularity a lot in the UK. But again, it's the same thing where at scale, can they compete with Domino's? And people, it's just the ease of use. We talked about the app, and it's that inertia, the fact that people just use it without thinking about it. It's become people are so accustomed to it that they don't really want to change. It's a bit like Coca-Cola. People are just so used to Coke that they're not really going to change their habits.
Guilty of that. Yeah.
It's so ingrained in culture and people's thinking that it becomes difficult to move away from that. But again, like I say, consumer buds can taste. People can suddenly, we've got a generation now which wants more healthy options. Yeah. And that's changing the narrative a bit. And how does Domino's compete with that? Because it might dominate the pizza market, but pizza as a sector within the quick service industry might be in decline just based on health factors. So
there's other, Pizza Express, for example. They've started offering sort of vegan and lighter, or Ligaro, how they pronounce it, pizzas, which is supposed to be healthier. I don't know if that's true, but they certainly look more green. So
exactly. No, exactly. And that's where there might be an issue. And that would be, I'd say, one of the main threats for Domino's is the secular decline in consumer tastes that might cause them issues going forward.
Yeah, that's an excellent point. I don't think it's touched on either. I mean, we've read a few reports about this company, and I don't think it's ever been mentioned about other than a brief comment, the potential shift in consumer taste, especially like we've just spoken about. There's a lot more sort of veganism going on. A lot more people are getting concerned about what they're putting in their bodies, and especially after COVID. Huh?
So I think great things they can do. Burger King did it with Impossible Foods, the Whopper, which is and that's where you might see things where they'll partner up directly with the likes of Beyond Meat or Impossible Foods to create these options. And I'm sure over time they might be able to get thin pan crusts and I mean, there's lots of interesting things they can do to become more health conscious. But the fact is, McDonald's, Domino's, I mean, these businesses aren't going away. I mean, they're growing year on year. So clearly the trend is clearly people do want a cheeky McDonald's or a cheeky Domino's, and that isn't necessarily going away. And maybe it's a part of that, right? Same with Coca-Cola, where there is an overall trend, but there's still a space for these. It's a bit like chocolate and desserts. There's always a space for these things in the market. A cheeky indulgement in having something.
Well, there's always room for dessert even after a large meal. So
exactly.
Okay, so we've done quite a brief overview of the whole company, but one of the toughest sections, which I think new investors struggle with, is to do with obviously valuation. Over the past 12 months, the stock hasn't exactly been the best performer. I think it's more to do with recent pressures. There's a lot of fear. We've already talked about it, about the drop in consumer spending. Energy bills are supposed to be going through the roof, and as a consequence, the market is assuming that companies like Domino's are going to end up selling less pizzas. But despite that, what do you think about the valuation today? Do you think it's under or overvalued?
So we like to do a DCF, which is a discounted cash flow model. So we take future cash flows and we discount it to the present. And the way we do that is, we apply discount rates and we apply various growth assumptions. And what I assumed was revenue is fairly flat, growing at 3%. Similar in line with sort of UK growth projections, and EBITDA is relatively flat, around 25%. I got to a sort of a share price value of 476, which is still quite a bit higher than where it is today, and that's saying the stock is probably undervalued around 25% to where the stock price is today, or if not even more now, given when we wrote the note it was 380 and now it's about 350. So still
it's come down a bit.
Yeah, so there's quite a lot of upside, and like we said, this is a simple model, fairly predictable. And if you price in a lot of downside and say, well, it's not going to grow much from where it is today, and it's just going to stay flat, then in an inflationary environment, can it pass on costs? Probably yes. It's quite an interesting business to have in your portfolio from a perspective of a consumer discretionary company, and one that's got a strong franchise and strong brand. So you could say it's a strong quality business, high quality business, which we discussed. Strong balance sheet, strong brand business, strong management. So it scores quite well in most regards, and something where the market's taken a hit. Be greedy when others are fearful.
Yeah, well, with all that in mind, it makes sense that you gave it the COG score that it has. For those who are new here, COG score is a way we essentially assess the quality of a business based off quantitative as well as qualitative factors. So looking at what we've discussed today, we're looking at the financials, we're looking at the management team, the competitive advantages, the threats that it has to face. And if you would like to have a look in more detail about the Domino's, we have a full sort of research report available, which you can read for free. There's a link in the description below, as we've already said. But I think that just about wraps things up for this week. Next week, we're going to be looking at another company from across the pond. It's a company called Trimble, which is very different. So stay tuned for that. Imran, thank you very much for spending the time with us today to go through this.
Thank you very much. It was great to talk as well on this company, and look forward to the next conversation on Trimble.
Sounds good. See ya.
Take care.